Well, good morning, everybody. We got PPI today, and we have Powell today. Shouldn't be that big of a deal, you know what I'm saying? It's just, it always comes back to the forum that they're speaking in. As you can imagine, if they go to a college or a university and they're on some sort of panel or giving a speech, then it really isn't going to have that much impact. And then sometimes they'll say it's a speech and really it's a recorded event, and then there's no Q&A. Um, we can't treat every event the same. And when you see a Fed speaker is supposed to be talking, and especially when it's Powell, instinctively you just want to be concerned and worried. But honestly, if you dig into it just a little bit and try to find out what it is they're going to be speaking about, where they're going to be speaking at, if there's going to be questions or not, then you can really avoid some angst that you didn't need, right? Just avoid the whole thing, really. So not all events are the same. Generally, when it comes to PPI, this one's not the big driver like the other one is. Uh, but there are times throughout history where we've seen the market make exaggerated moves from PPI. I'm going to continue to stress the point that it really isn't the data, anyways, right? It's whether or not the market anticipated that data in an eloquent way and or is caught off sides when the numbers come out. Because remember, there's a lot of people out there, a lot of very smart, very intelligent people who's done enormous amounts of back testing and research and has their finger on the pulse of all these data points. For the most part, the numbers don't shock and awe. They're in line with forecasts and estimates, and it's not a surprise. The biggest movers come when the numbers are a surprise. Catches people off sides, and then everybody's scrambling to change the sides. And one of the things that I like to do for this is my morning routine. I'm listening to Bloomberg, and really it's just something going in the background. I'm not paying too much attention to it, kind of making sure that no, you know, dastardly events are happening around the world. Something really bad didn't happen while I was sleeping. And I'm listening to the tone of what they're talking about in the morning. Are they excited? Or, are they cocky? And that brings us back to CPI, PPI, and really these economic numbers. When I start hearing them so confident that they know the numbers, oh, we know it's going to come in hot today. We know it's going to come in. They don't know. They don't know, and if they're caught off sides, they're going to get slammed. And there's been times, especially with job numbers, there's been times where they were completely wrong and the market just slams them hard. The more cautious they are, the less movement we see, which makes sense, right? There was less conviction. People didn't stay in their positions or they hedged them more. And then we didn't get those big moves. And then, of course, how much they talk about the move. If it's supposed to be a big move and they keep saying that, oh, this is a big one. It's going to be big. It's going to be big. It won't be big. Everybody will hedge that thing to the eyeballs. There'll be nobody that's caught off sides because they'll have hedged in both directions. It won't matter what the market does. And then nobody's scrambling because nobody's caught off sides. So, just approach all of this with a little bit of common sense. You don't need an economics degree, to be able to figure that part out. Just slow down, consider why the market would make moves from everybody being off sides, and then try to pinpoint the confidence of the trade and whether or not they're hedging. And when we get to the chart this morning, I'll show you that they are not hedging, not yet. So they're not too worried. We do have more than Powell today, too, when it comes to Fed speakers. We're also going to get more out of the European central bankers. And tomorrow night, we're going to get more out of Japan. So tomorrow into Thursday could get pretty interesting with the numbers from Japan. Uh, it's just going to be that kind of week, between PPI, Powell, CPI, and then these numbers out of Japan. That's going to get us, really close to Friday. And if you had a chance to look at Spot Gamma's founders notes, it's been pretty cool. They've had that AM edition done every day this week. Of course, it's only Tuesday, but still, it's pretty cool. They got it done before I started. They did point out the obvious resistance or call wall overhead, and that was about 2% on the SPX. Then they laid out the SPX support levels that need to hold, and they also discussed what it would look like if we break it down, and where those levels would be. So worth a read if you haven't yet read it. The founder's notes from Spot Gamma for this morning will provide a little bit of that insight. We are back into the meme craze. If you haven't caught that yet, the whole Reddit meme craze is kicking off. Feel really good on the fact that I spotted that yesterday morning after the briefing, looking at the scanners at what was up and what wasn't up, and went and ran a short float scan and had posted the findings. You can do that just using a Discord bot, right? You can just look for a short float or short interest, calling it out on the bot, and that way you don't even have to go looking for it. But there are websites too, that are dedicated to hunting down short float names, short interest. And if you don't have a subscription to any of those sites, you can always go to FinViz. Even without a subscription to FinViz, they have a robust screener that will give you multiple ways to screen for those stocks that are in a potential short squeeze. So we're going to see a little bit of capital rotation through this, a fractal rotation. Just remember in the big picture that those don't last, right? That this whole thing doesn't stick around long. And I believe last year it was February when we had a really good run. I don't know. I'll have to circle back on that because I don't quite remember when it was. But it's been a while. It's been, feels like it's been at least a year. So we can see the low volume this morning. We're sitting at 39, just round it up and say 40,000 for the overnight. And our window is generally between, say, 70 to 90. We start getting above that, then we're getting into some elevated volumes, and below that, we can really see some lack of participation. Generally speaking, when we have this low overnight volume, we usually see hedging. And that makes sense, right? They're standing aside, they're getting out of the way, and then they're hedging their positions. But that's not what we have here. They stood aside. Lack of volume is present and clear, but they're not hedging. And if they are, then they're not hedging in the front end, which is okay. I mean, they can hedge however they want. They're just not hedging how they normally would. So it is possible, that because we have PPI as well as CPI, that instead of hedging today and then hedging again tomorrow, that they're just going ahead and doing both hedges at once using tomorrow's contracts, and that's why we would see that 17 one right there. And this very well could explain why we're not seeing the hedging. Rather than using the 0-day options like they normally would and hedge up in the front end, they're using tomorrow's options to hedge for today and tomorrow. So really, I don't have the proof that I normally would have if it was a 0-day, but to me, I'm very confident that they are hedging. They're just using tomorrow's options. Obviously, it would be better if we could point to something and say, you know, we have this signal. They are absolutely hedging for a fact, but I'm pretty confident in what we're seeing here. That's a seriously elevated number. They are hedging. So to validate this as the morning goes on, we're going to want to see this number right here, that 1704. We're going to want to see that continue to climb. That will help validate this theory into around 9 a.m. After that, it should perhaps level off a little bit. And then, of course, when we come in tomorrow, we will see that market maker move if that number is still higher than the next number out. Because remember, by tomorrow, the front one will be gone. So it will look more like this, where we have 17 over 15. We'll have the market maker move emblem up there and will be hedged. So a lack of volume with hedging implies that there is risk on the table sufficiently concerning. Otherwise, they wouldn't spend money to protect themselves from it. If we didn't know what it was, we would want to go look. It's not hard to figure out today, right? We got PPI and CPI, but this is a learning process and trying to point out how these tools can function and help you. If it was just any normal day of the week and you came in and see the volumes this light and you recognized that hedging activity, then you would definitely want to know what's going on. Why are they spending money to hedge? What are they worried about? And go look. We are fighting with a voodoo line right now, this green line running across my chart. That is a voodoo line called forest. It's really imaginative, right? They made it green and called it forest. The voodoo lines are a little weird. They're proprietary from the creators. They don't exactly tell you what they are in all details. The indicator doesn't calculate anything because I can read Thinkorswim code. They you have to go download it from them about every 6 weeks or so, 8 weeks, and they hand place those levels. So it's not even like, you know, we can reverse engineer it and try to figure out what the levels are. It does have a little bit to do with Elliott wave. That's one thing that I know, but other than that, the parts and pieces are vague on purpose because, you know, it's proprietary. They don't want to share out all the secrets. I don't trade with it because I don't know all the parts and pieces. I don't trust it, but it has over the years proven to be a level where price responds, not just that green one, but all the other voodoo levels as well. So I tend to pay attention to them even if I don't trust it. And you can see how we're there fighting with it. We've been fighting with it since all the way back here when we first ran up into it. First test and then breakthrough, right? That's how it goes. We have a really tight range this morning. Take a look at where the call wall is all the way up here. It's about, on the SPX, it's about 2% away. On the ES, about a 1.5% move from our current location, and we're basically flat on the day. To get there, we would have to cross through the ADR low and the ADR high and a couple of voodoo lines, plus some cog lines and a round number just to get to that. I'm not saying that it's impossible, just that that's a lot of resistance to work through. Same thing for any move to the downside. We've been holding here for a little bit, so we've had time to build up levels on each side. We got the 10-day below us, the 3-week below us, volatility trigger, 0 gamma, 20-day moving average, the 10-week moving average, ADR low, and red line and yellow line. And below all of that, we still have all these different voodoo levels. I can't remember what the purple one or fuchsia, whatever color that is. I don't remember what they call that one, but it's another voodoo line. So are these kind of green lines here. A lot of cog lines on the way down. And finally a put wall all the way down at 50.24. I mean, they really moved that thing out of the way. So no matter which direction we go, we've got something that we're going to hit relatively close. If we look at the central pivot range, it's basically side by side with yesterday's range. It's a little more narrow, but not narrow enough to trigger any sort of the NR4 and NR7 and narrow range plays. We did open underneath it, but we've come back to it. So any sort of magnet is already done. And if we just take everything off of the chart, come out to the daily and mark yesterday's close. This way there's no disagreement about, well, which close should I use? The 4 o'clock close, the 4:15 close, the 5 o'clock close, or maybe we should use the Globex open. Just save yourself all that trouble, mark it on the daily time frame, and now you've got the daily close marked. Take out the high and the low from our own Globex in both directions. And you've got some intermediate levels that you can play against on whatever time frame you happen to have been on. That's an 8-point range all night. It's pretty impressive. That's tight. Just to give you a little context, though, back in the day before COVID, we used to have 8-point days. Not once in a while, but a lot of times. We're talking from 9:30 open to 4 o'clock in the afternoon. We'd move an entire 8 points, maybe, for the whole day. So for anybody who wasn't trading back before COVID, and you have days that look like yesterday, these big sweeping moves and good 20 and 30 and 40-point days, enjoy them while you have them. Because when we go back to, an 8-point day or a 12-point day, you're going to miss those big runs. It's also why it's important to figure out how to make money on a small move, right? I always see people trying to catch these big 10-point runs and 15-point runs. And hey, don't get me wrong, I like a big 10 or 20-point run myself, but those don't pay the bills. When we're no longer in an environment where you can get 10 and 20-point runs because the entire trading day didn't even move 10 to 12 points, you're going to have to figure out how to make money on a 2-point move or a point and a half. We are underneath the ADR low, which lines up really nice with our own Globex high. So it stands to reason if we can break our own Globex high, which also happens to be the midpoint, the halfback, then we'll work through each of these levels on the way up. 52.50, 52.56, 52.60, and just on up until we get the inside day breakout from above. That breakout is going to be 2 levels of resistance, right? Because it's also this level from Friday. So we've got 2 levels of resistance to break through here at our own Globex high, and then 2 levels of resistance to break through when we get to yesterday's high. Again, I'm not saying we can't do it, just that the levels are there. if the numbers surprise today, when we move, it won't care about levels and pivot points and double resistance levels. It'll just run right through anything that's in its path. So keep that in mind. The initial burst will wipe out anything in its path. After that, then we have the pivots and the levels and all of that. For the downside mood, if we can break our Globex low, then we can focus on, say, the Globex low of yesterday. That doesn't really offer us very much, but then also the low of yesterday, which does line up with one of our measurements already. $10-day, 30-minute volume profile and TPO. As we talked about last week, the point of control was going to move up. It did move up. It's now underneath this. Should we break our own Globex low and fade down, then that's the last line of defense. If that breaks, we can very easily go to 51.50. The point of control here is also at the cog line 52.11. They're close enough to just line up. We've spent more time at 52.43 area. That's why the point of control has moved up on the TPO. And it's got this nice shallow area. So that's a quick drop through that zone. And then if we break the 52.11 cog line or the point of control, then we got another shallow area to break through down into 51.50. So it all comes back to CPI, PPI, Powell. Nothing on this profile is going to change as far as width unless we break out to the upside or the downside, right? Normally, as the day goes on, we can lose one side or the other, but we won't lose these bottom prints until next week. And just to kind of demonstrate, as each day goes by, the profile would get narrower and narrower, but only after a week has gone by. It's not going to happen anytime soon. So we're not going to get that constriction here in the profile anytime soon. We're also expecting to see the point of control move up to our current location. And that was from volume. And this is kind of important to realize. The point of control right now is because of just this much volume. Okay, I mean, it's not a big deal, right? And it moved up from down here once we lost some volume, right? So volume dropped away, point of control moved up to its current location. I point that out because it moved to this spot kind of on default. It just, the other location, as each day went by, faded the volume down enough that this just by default became our point of control. That's not what we're experiencing right now. We're not losing any of this volume anytime soon. I already discussed that. But we're getting so much volume here now in the last few days that we're going to move this point of control up without having all of these disappear first and eat that volume away. So we went from a topping pattern to another leg up and now into a topping pattern again. So we want to pay attention to this, see if we can register above it, get one more leg out, or if we're going to pull back and start cutting through these lower levels. Because if we do, we now got 2 levels of resistance overhead that'll be significant and make it more difficult to rise. 5-day, 5-minute, call it mapping out the 5x5. Yesterday did not offer us a VPOC, so we don't have a new one to put in place. We've still got the last one, the old one, 52.30. So if we do make a move to the downside today, there is a cog line 52.32, but there is also a VPOC 5230. And that's close enough anyways that we would just consider that one zone, that entire 5230 area, as an area of interest. The reason I took the time to discuss the 10-day with the profile having the volume at the very top is because it's going to register a classic P shape by the time we're done. If we get that move up, see if we can find an example here on the 5-minute just to point that out. Yeah, this one will work. So here we can see that classic P shape with the point of control in the upper portion of the day. Now this isn't as clean as I would like it. Would like it to be a little more skinny along this tail here. But when you're studying volume profiles, here's a classic B, I guess, if we were just to look at that, right? And not just kind of ignore that for a minute. If it was really skinny like that and just had this profile at the very bottom with the point of control, it'd be your classic B. These letters and their representation are important. They have a lot of context and value behind them from an analyst point of view. That's where TPO charts and footprint charts, monkey bars, where those really get their strength, right? It's what makes them so valuable is that background and that context. That's what we're going to end up with on our 10-day profile if we get that point of control to move up, right? That's kind of the logic behind why I took the time to dig a little deeper there. So far on the week, we've done nothing. This is the weekly expected move. It's how far we should go from the high point to the low point. So one standard deviation. We're supposed to close inside the box. For any other market, 70% of the time. If this was, a box on Apple or Meta, whatever, because it's one standard deviation, that's 70%. But for the S&P, it's got a much more accurate expected move, and it tends to close inside the box 80% of the time. Rather than counting back every single week on the chart, you could just count back the last 10 weeks and look at how many times on Friday afternoon when the market closed did we close outside the box. If it's more than 2, then we're breaking that accuracy. It happens. If the market makers aren't pricing the volatility in correctly and it's not showing a good enough range, then we break the range really easy. Or the market is not seeing that priced in volatility and it has a different form of volatility coming through from somewhere else. Remember, all markets are connected. We could have a big move in treasuries and that could move the ES. Well, it's not the ES's fault with the implied volatility range if we break it because of something that happened in treasuries, right? So the volatility that can move us doesn't always have to be on the market that we're looking at. And that's another reason that we could break these ranges on Friday, like we did last week. We closed outside the box on Friday. It's just a representation that volatility still is not being accurately or adequately represented in our tools, like implied volatility and the averages and ranges. It's still a warning or a threat about using iron condors or other box strategies that tries to put price in a range and says, I bet you won't leave this box, because you know what price is going to do. So break the box. For the year, we've continued to hold around 1.5% above the 10-day moving average. That's been our sweet spot on the year, and so far that is still holding true. So in this last run that we had in the S&P, well, the ES either way, whether it's the SPX, ES, SPY, we've been holding around that 1.5%, We got up into that. That was our distance from 10, and now we've faded back again. Price didn't really fade back. All price had to do was hold still and let that 10 come to us, and this is a great representation of that. We rallied up and paused, and the 10 each day has gotten closer and closer and closer to us, and so we're coming away from that high point. We're still not overbought, not overextended. We're not looking for any mean reversion at this point. It doesn't owe us anything. Looking at the 10-week, same thing. We are on a bit of a fade back. This implies that we're still just getting started. We spent, all of the year so far, really all the way back to the November QRA, we've been riding above that 2%. This is distance from 10 on a weekly chart, and staying more than 2% away from the 10-week moving average is what we've done all year. So right now, we're still just trying to even get that going. I like to look at this from a point of view of how much further could we go before we really need to see a pullback in the market or a pause in the market. We could move another 2% higher before I would start to consider the market a bit overbought and maybe needing to pause or slow down a little bit. 2%, pretty good with that. I don't have to worry about topping out or running out of gas, right? So we can look at the equities this morning, but really with PPI and CPI on deck and Powell, everything could change between now and 9 a.m. because of this PPI report. So I wouldn't waste too much of my time or effort looking at what's up or what's not up because of that. Also, do keep in mind with this meme craze, even short-lived means, it can go from a 24-hour cycle, which we already know it's gone longer than that now, but it can go for a couple of weeks. And there's so many beaten down names that are heavily shorted companies. Even for a short duration, a couple of weeks, if the money flow changes out and starts chasing after that, even for just a little bit, then a lot of things are going to stall out. It doesn't mean they're going to crash and burn or that we're going to turn back into a bear market, just that there's only a finite amount of capital out there. And if it's not going into the things that we have been trading and instead starts chasing after all these beaten down, left for dead trash companies, then that's where all the money's going to go. Also on that same theme, if they need the capital, they're going to sell out of one thing and get into another thing. What's down this morning is Bitcoin, China ADRs, Nat gas, and our benchmark is 0.5%. I want to see things down or up at least 0.5%. And that's only because we're doing this morning briefing so early, right? I have to do it early so that you guys have time to prepare, but also because I've got things to do before the market opens. But this is a teaching tool. You're going to want to do these steps closer to the open. And when you do that, you might want to use 1%. A lot of analysts that I know use 1% as their starting point. Otherwise, you'll get so many things on your list that it's overwhelming, right? You don't want a list of 40 names as you come into the open to trade. 4 would be good, not 40. So it's all a part of that narrowing down process, right? We start with 600 companies that have options, and we try to funnel that down until we got 3 to 6 names total max. And part of that narrowing down process is how far have they moved this morning? What kind of volume did they have this morning? So we're early. I use 0.5%. But as you get closer to the open, if you do these steps try bumping that up to at least a 1. And if you're still getting a ton of names at 1%, bump it up again to 1.5%. Continue to funnel that down. So those are the things that are down. What's up this morning is retail, VIX, biotech, solar, gold miners, uranium. But really, that starts getting us back into too low, right? Gold, uranium, they're not quite up enough. You don't want a stock rally on solar technology. And it's interesting that solar is up because usually it's tied pretty close with China. We would see, China's up, solar's up, but that's not what we have this morning. We got a lot of things flat that isn't even offering us something. Normally we'd get a little bit. This market is on pause. Everything is showing us that it's on pause. And if we're lucky, we might find like maybe some pot stocks or something. It is good to see retail up. That reminds me, Walmart has earnings this week. Home Depot just had earnings. That didn't really work out too good. It's not dumping down, really. It just didn't have a good earnings. So, that might be worth watching this morning. If it bucks the trend and throws off that negative earnings and actually rallies back out today, could get a nice move above 350. I did mention pot stocks. They are up this morning, but that's not really much of a print, right? If you can see it, and I know that these little dashes are hard to see. That's not what we want, right? We want to see some pre-market activity that's got full candles, price that actually made a move in there somewhere. These are just little algo prints. That's not what we want. So sure, pot stocks are up through the MJ ETF, but I would say we need more than that. We got cloud computing, cloud services. This one's a tricky one. A lot of times it'll move after hours. And then in the pre-market, it hasn't moved at all. And it's still showing you the after hours move. So this one rarely moves in the pre-market. And when it does, it's almost always one of these little dashes. That, again, is not what we want to see. So I'm just going to kind of set that aside for the moment. Move on to silver. So silver is up. We've got this really tight ranged inverse head and shoulders. It's a little sloppy, but it is there. The problem is if we were to mark that out and measure it, it's already made its first move. And a lot of times that's all you get is one. But there's a 50% move and then there's a 100% move. So if we are going to get that next run, then it'll run us back up into about $27. But right now we're fighting underneath 26. I would say capture that half back, get above that first, then get through that big red candle. Then we can focus on working back up into 27. I'd choose 26.50 maybe as my first target. This is really struggling. Now that we've set a high in a Globex, that'll now be the level to get through too. So get through 26 with a target into 26 and a quarter, which should put us on focus for last week's high. If we can get through 26 and a quarter, then we'll target 26 and a half and then on into 27. 26 and a half does line up really good for a halfback. I know it's not perfect, but if we were to mark a halfback on this big candle here, yeah, 26.36. So we'd actually be beyond the halfback at that point if we can get to 26.50. IWM is not up enough, but it's up close, right? It's up 0.47 and 0.5 is our goal. So we want it up just a little bit more. Look at it on the daily range here. We're stuck inside this really big bar. Got to get out of that. This is IX10, but since the bar is so wide, there's no excitement over that, right? We want an IX10 on a very narrow candle set, not a really wide candle set. I did mention that the meme stocks are back again. You can see that in GME. There's a number of meme stocks right now that are getting this sort of treatment, but I mean, it can bleed into all sorts of things. Kroger, for an example, a few years back was a part of that same list, right? The whole Reddit crowd list. It can go from AMC, GameStop, it's beaten down airline names. Really, it can spread out all over the place. And all you got to do is run a search. You'll find those. The one thing I can say is at least those are going to completely disregard PPI, CPI, Powell. Those aren't going to pay any attention to any of that. So if you're trying to just find something to trade while you're waiting on all this economic data to get out of the way, maybe those meme stocks are the way to go. Just keep in mind that when it does dry up, it does dry up fast. Some of these are going to make really good short trades, right? Where you can sell options against it and just watch them tumble back down again. Just add some time because, like I said, you don't know how long it's going to last, but it won't last. That is the given for all of it, is it won't last. It's interesting that Riot used to be on that list too, and Riot isn't getting the treatment this time. All right, so you got your levels. You know what to look for today. Watch the clock. Be careful. Be safe. I'll see you.